Right.
Yeah.
Well,
And, if the Fed comes in and buys the entire US government bond market, which arguably it would have to do if the stock market went down 40% and the bond market sold off hard and interest rates went up a lot, you're on your way. I mean, and that's a 200,000 plus Bitcoin price going to 1 million, and that's a $5,000 an ounce gold price.
In this riveting interview with Natalie Brunell, financial experts James Lavish and Larry Lepard share their compelling insights into the economic storm brewing on the horizon. Both veterans of the financial world, Lavish, an expert in institutional investing, and Lepard, a renowned sound money advocate, unpack the train wreck they foresee in the global economy. They delve deep into why the Federal Reserve is trapped under a ticking debt bomb, discussing whether the central bank can navigate this crisis without triggering a major recession. This video distills the most critical moments from the interview, offering an eye-opening look at what might lie ahead for the economy. If you're looking to stay ahead in the world of finance and investments, subscribing to Financial Navigator is a smart move. Whether you're interested in understanding cryptocurrency trends, stock market strategies, or just want to gain deeper financial insights, our channel offers you expert analysis and easy-to-follow guidance. By subscribing, you'll ensure that you never miss out on timely updates, actionable tips, and valuable content designed to help you make informed decisions. Plus, as a new channel, your subscription directly supports us in growing and bringing even more high-quality videos to the community. So hit that subscribe button and start navigating your financial future with confidence.
Um, Look, from a very high level, the Fed they have two mandates, right? One is stable pricing, and that means in their terms, basically, they've defined that as a constant 2% inflation. Okay. If it gets above that, they try to bring it down. If it gets below that, they try to bring it up because they want a constant 2% inflation. Why that is, we can get into later. But the second thing they have to do is their second mandate is full employment. What does that mean? There's no real number around that. There's no metric that they can point to, but it just means that they look over a long period of time. Like, where does it feel like we have full employment in the economy? So what we've seen over the past, I'd say about last 3 to 6 months, is inflation has come down. It's kind of leveled out here, in my opinion. It's kind of leveled out at around 2.5 to 3.5%. But then the Fed came out a week and a half ago, and they said, victory, we can start lowering rates, and inflation is not a problem anymore. Now we're focused on the employment numbers and the employment situation, because we don't want that to spike up and have a real high unemployment rate, which means that we're heading into a recession. But that's kind of where we at, and there's a whole lot more to dig into there, but I'll let Larry fill in anything you want.
Yeah, and as you both know, and as we all know, first of all, the inflation numbers are a joke because they're not accurately calculated, and they don't really reflect what we're all paying in terms of inflation. I mean, I had a home where the homeowners insurance went up 100% year over year. My auto insurance is up 35. I mean, there's just no way that what they're reporting is real. And shadow government stats. John Williams has documented that for years. But being all that as it may, it is arguably lower than it was when it was at 9%. I mean, things are not going up as quickly as they were at the peak of, the pandemic and when they were still printing money excessively. And so, yeah, I mean, they've declared victory, but you've still seen some of the mainstream economists come out, like Cargman, has come out and say, well, they should have a higher target, which is just, absurd. And my view is it's really just a temporary phenomena before the next wave begins. And in fact, something we should go into it. I think what kicked off the next wave happened last week, which is when China came in, and very much like Mario Draghi saying, I'm going to do whatever it takes to save the euro. China said they're going to do whatever it takes to save their economy, and they did. They came full barrel with QE. Fiscal stimulus, supporting banks, making direct deposits in banks. I mean, it was really quite stunning. And on that day that they did that, a lot of commodities went limit up. I
mhm.
mean, rubber, copper, tin, some of the other widely traded
Right.
commodities.
The actual cuts weren't that big, but all of the things they did together was like,
Right.
whoa, there was a lot.
Exactly.
It ended up being a bazooka, you know?
Yeah, and the messaging around it was very much of we will do whatever it takes to stimulate our economy and get it going again. So, and if you look at the charts and they're very widely available on Twitter of M2 growth, global M2 growth, particularly, China is just, it's going straight up. So they've got the printers turned on full blast. And that has been reflected. I think last week also you had gold making record highs,
Hmm.
silver close to breaking out of kind of a 3250 cap that it's been under for quite some time, and then Bitcoin coming nicely off the 58 that we were kind of stuck at, into the low 60s. So everything today is backing off a little bit, but markets breathe up and down. But the bottom line is that the fiscal situation, as James has so many times laid out, and I've laid out as well, that the debt doom loop that we've got absolutely requires that they continue to print money, because if they don't, the whole thing collapses. And
Right.
so they take turns. The U.S. does it at one point in time, China does it at another. They all add to the global M2. And so, my view, I think it's James's as well, is that we are going much higher in all of the assets that government can't print.
What we do know is, but the point that Larry was making is that it's kind of across the board, and China is important. China has a 5% GDP growth rate target. That's higher than ours, and so they want 5% growth rate. And if that means they have to do it through stimulus, they're going to. They are suffering what could be a deep contraction if they don't stimulate. So the amount of that, I think, is going to end up being more. We have to look at the figures, but the reality, and going back to the Fed though, Natalie, and what is so important about this is, I mean, look, the U.S. economy is like 25% of G20. I mean, it's a massive amount of the economy, and M2 is really important. But looking at what the Fed is doing and what's important about this, and why it's so important that they have kind of declared victory on inflation here, while it's not really tackled yet. So if you go back to what Powell says, Powell has declared over and over again that they look at PCE, okay? And that is the metric that they want to look at, is in specifically core PC, which pulls out food and energy prices. So this is the price of the consumer expenditures index, and so it's a little bit different than CPI. It's also manipulated. It does use CPI underlying data to calculate it. It's kind of all incestuous, but the important thing here is that Powell, in the meeting, in this last update in the press conference, in as is written notes, his statement, he said we have a peak into inflation. It looks like it's going to come down to 2.2%. Okay, the PC was released. It was 2.2%, but that's not the core PC, which pulls out energy and food, which he keeps pointing to as important because that's a real volatile, food and energy is volatile. Mm-hmm. So if you look at inflation, we're still at the PCE, we're still at 2.7%. We've kind of hovered there. So I don't know if you've seen this chart, Natalie, and I'll see if I can find it so we can put it in the show while we talk about it here. But there's a great chart that shows the inflation rate of 1970s, how it really peaked up. It came to kind of a peak, and it came back down, and then it ripped higher again.
Yeah.
And if you overlay today's inflation trajectory, it is following the exact same path. It's actually a little bit frightening how closely correlated it is. Now, it's a different metric, so we didn't go as high this time. We only went in the 9%, 9.1% range, versus the 1980s where we went into the 20 range. So it's a little bit, but the trajectory is very similar. And so my concern here is that as the Fed turns its attention to unemployment, that they're so concerned with a spike in unemployment that they allow for the expansion of the money supply to continue. They lower rates, okay? They brought them down by 50 basis points. Why did they do that? Well, we didn't have a meeting in August. So they were kind of a little bit behind the ball here, and they know it. And so they have this, they're walking a tightrope. Do we really try to clamp down on inflation by holding rates high for long, or do we lower rates in the hopes that we kind of head off this spike in inflation, which happens every single time that we lower rate? It's happened over and over again. So they're kind of walking this tightrope of, okay, we're being really careful here, because as we do this, we might get into a period of what's called stagflation. And Larry's lived through it. I've lived through it when I was younger, and it is painful. You do not want to live through this. But that's exactly kind of the trajectory we're on, which is so frightening to us as investors, because how do you approach that? And why gold is doing so well right now, and why I believe Bitcoin will do well on the backside of this. I think we'll still have volatility in the meantime. And Larry, I know you've got some comments on that, but.
Well, yeah, I mean, look, Bitcoin's going to outperform gold, no doubt, over the longer term. But gold has always been more attuned to what the Fed's doing, and inflation, and monetary debasement, just because there are more gold holders in the world than Bitcoin holders, and they smell it early. And to your earlier question, Nat, of, have they really turned the printer back on? I mean, the answer is no, but they've taken a couple of steps in that direction. They said they were going to stop tightening. They did that when things blew out last fall, and they got scared that the 10-year was over 5%. So that 12 people within 10 days came back and said that the rate hike cycle is over. And now the rate cut cycle has started. And then they took QE and they cut it in half, actually more than half. They took it
went from 60 billion a month. Yeah, 60 billion a month down to 25 billion a month.
Down to 25, exactly. And we're just,
which is nothing. Let's just face it. That's nothing. That's just letting some of the treasuries roll off the books. They're not actually out there selling.
And I predict that they're going to do probably 2 more rate cuts this year, and each one will probably be 50 bips. And the reason for that is that the interest expense is eating them alive, and they know it. And they've crafted the narrative in the way they have to craft it to allow them to do what they have to do. I mean, as James said earlier, they've got 2 mandates. They've got the inflation mandate and they've got the unemployment mandate, but they actually have a third mandate. It's not specifically in the legislation, but they've mentioned it many, many times. And that is what we call functioning financial markets. And we know that when the third mandate comes into play, like it did in March of 2020, when the bond market went no bid, that they step in with enormous liquidity. And so, I think what we're waiting for is until that event occurs. And, Powell's going to have his own, Mario Draghi-like moment. He's going to be a deer in the headlights, recognizing. And the clue will be, the dollar will fall sharply. Bitcoin will be screaming, gold will be screaming, and the bond market will start to fall. I mean, yields will go up, the prices of bonds will fall. And right now, the bond market's still somewhat tame. Everybody's doing the standard playbook, which is, the economy is going to slow down. Therefore, you want to own bonds because rates are going to be coming down in the future. So that's really the tell that both James and I are watching for. And you're starting to see it a little bit in the long end, right, James? I mean, in the 20 and the 30 year.
Yeah, I was going to say that. In fact, if you look at the yields are higher today on the long bonds than they were before the Fed cut rates by 50 basis points. What is that telling you? It's telling you that the expectations for long-term inflation are high, that the R square or the R star, the neutral rate is higher than people had expected. So that means that the Fed probably, in their own estimation, they're looking at 3% as their kind of their terminal rate, where the rates finish out on this cycle. Now, what does that mean? That means that there's likely there's definitely a risk of inflation spiking here, or else they wouldn't be holding it, at that. They wouldn't be holding their expectations at the end of next year at 3%, and the long bond is going to end up trading with a yield higher than that.
Yeah, I mean, I think what's going on, Nat, is that the world is waking up to what James and I have known for a long time, which is that they're trapped. They're absolutely trapped. And that's why you're seeing record high gold prices. And that's why you're seeing silver breaking out. And, gold smells it, and it knows what's coming. This is, as our friend Foss says, it's just math. There is no mathematical way out of this
Yeah.
That's
without
right.
them printing more money. I mean,
Yeah,
if they don't print more money, the thing collapses.
yeah, and the trapped, just to give some meat on the bone around that, right? So what we're talking about here is, look, if the government, if the Fed allows us somehow to drop into a recession, right? So right now we're spending $6.9 trillion annually, right? So, and if the CBO is that's what they're expecting. It's probably going to be more like 7 or 7.1 this year. But you figure that in an event that we have a sharp downturn, and Larry and I have talked about this before, you figure it's about 10 or 12% of a rise in expenditures. So now you're talking about an extra, let's call it an extra $1 trillion. And at the same time, you're going to have a drop in your tax revenues, and we're super financialized, right? So if you have a drop in the stock market goes down, companies not making as much money, they can't borrow as easily. We have expended, or the tax, the taxes that we collect are down by another, let's call it $1 trillion. Now you're talking about a $2 trillion deficit that becomes a $4 trillion deficit. That's trapped. So how do they deal with that? They can't deal with that. I mean, imagine the deficit going from 35.6 trillion as of probably tomorrow to 40 trillion in just in just a year. I mean, it's devastating, and they are trapped. They are going to try to avoid this. Part of it is that part of the economy is in recession. You can see it. Lower demographic is hurting. The credit card default rates are over 11% now.
Right.
The multiple of the cost to buy a home versus salaries is at all-time high.
Yeah.
The food inflation has just been insane. Yeah, and inflation is down, meaning it's decelerated, but we're still up, 2 or 3%, 4 or 5% from last year. I mean, look at your grocery bill. And so clearly there are pockets of recession. Both my kids just graduated college the last couple of years. They've been fortunate enough to get jobs, but most of their friends are struggling. It's not easy to find a job right now as a young professional coming into the workforce. That's an indication. I feel like it was in 1994 when I came out. I mean, it was a difficult economy to actually get a job in, unless you were going to Wall Street or and to some sort of emerging tech company. So, but the other side of it is exactly what you were saying before, which is that massive fiscal stimulus. And there's so much government spending, and a great percentage of the jobs that have been created in the last 2 years have been government jobs. And a large percentage of the jobs that were so-called created in the last couple of years have been revised out. So you had 1 million jobs taken out of the calculation last month, and so it's difficult for you to see exactly. But the point is, and what Larry and I are both kind of arguing for or explaining here, in our opinion, is that the government is trapped, and they're going to continue spending right through it and continue flooding the market with liquidity to avoid a sharp downturn. If we see one, it'll be a V recovery, just like it was in 2020, like Larry said, because of this.
Right. I tend to be of the David Hunter camp that we're going to go into a melt up, just that they're going to continue to cut rates. And it's, this is the biggest stock and everything bubble in the history of the world. And it's going to, in my view, get bigger. But that doesn't mean that at some point it won't end. Right. And at some point there will be no buyers left, and it will end. And it will end very badly. And when it starts to break, I mean, they can't handle a lower market. And when the stock market starts to break, the negative wealth effect, et cetera, is going to flow through to everything. And as James points out, in 08 and 2000, when we had those big market downturns, the deficit grew between 6 and 10% because, tax receipts come down from the stock gains, and costs and social costs go up. So, we're running a big 7%, 6-7%, GDP deficit right now. Imagine when that doubles in size. And and then the bond market fails, and the only way to solve that is to go buy all the bonds. So, the Fed balance sheet goes from 7 trillion to, take 36 and add it to 7, right? I mean, there's really an unbelievable train wreck coming at some point. But until that time, hey, the band is playing on the Titanic and everything looks fine. Now, where's the iceberg? I don't know. I mean, I'll tell you one other macro data point that I think we should discuss, because to me, this actually drove gold in a big way. And I think it shocked a lot of people. Last month, or a couple weeks ago, they reported last month's federal monthly deficit, right?
Yeah,
And it was $380 billion in the month, 90 billion more than forecast. They were forecasting a deficit of 290 and they came in at 380. I mean, and I think that was, I don't know if you remember when that occurred, James, but gold and silver took off like rockets when that was announced. And it's, I think,
absolutely.
right. I mean, now it's, look, this stuff's lumpy, so you can't take that month times 12, right? But the point is, this is really out of control. I mean, this government is out of control. And you had a presidential debate where no questions were asked about the fiscal or economic, situation or balance sheet of the U.S. government. Nobody dares to go there. I mean, it's just not talked about. And yet, there's a train wreck coming, a big train wreck. I mean, I'm writing a book, and this is the topic of the book, right? That you've got to actually hold assets which cannot be debased, because we know, based on prior history, there are 50 years of example that if and when that train wreck occurs, it would look like the Great Depression in terms of a deflationary impulse. And then we know that the policy response would be, we are going to print whatever it takes. And the Fed balance sheet, just as the Fed balance sheet went from less than $1 trillion, 900 billion to 3 trillion over 3 or 4 years with QE and Bernanke, and then it went from 3 trillion to 9. It's come back to 7 under Powell. The next one's going to take the Fed balance sheet to 25. And at some point, the way, and I'm not suggesting hyperinflation is my base case, because it's not. It used to be a complete tail risk. I'm now thinking it's kind of a 10 or a 20% case. But the way that hyperinflation occurs is when people lose confidence in the currency and they say to themselves, just get me out of this currency. I know it's worthless.
Right.
And, if the Fed comes in and buys the entire U.S. government bond market, which arguably it would have to do if the stock market went down 40% and the bond market sold off hard and interest rates went up a lot, you're on your way. I mean, and that's a 200,000 plus Bitcoin price going to $1 million. And that's a $5,000 an ounce gold price.
As we wrap up this eye-opening discussion with James Lavish and Larry Lepard, it's clear that the economic challenges ahead are monumental. Their expert analysis gives us a sobering yet crucial perspective on the financial landscape and the difficult decisions the Federal Reserve will soon face. If you found their insights valuable, don't forget to like, share, and subscribe for more in-depth conversations on the future of finance. Stay tuned for more episodes as we continue to explore the forces shaping the global economy. Thanks for watching.